and welcome to the first edition of Analysts Insights, which is powered by ZFN. We are going to be looking at a review of the financial markets and what's happening in the business sector. And I'll be your host, Avonga Jaya. Now, to break the ice, we are going to have a review of the local capital market performance in the last 4 months. And to help me do that, I'm joined by two leading analysts who are Rangamakwata and Rufaro Zengeni. Welcome, gentlemen.
Good afternoon, Taonga.
Thanks for having us.
Yeah, so let's dive into it. Ranga, can you give us maybe your view of the capital market performance in the last 4 months? Then Rufaro can add his view.
Thanks so much, Taonga. So the last 4 months was a hive of activity. We saw the market in the first quarter gaining more than 70%, and obviously, and also in the month of April, maybe another 3 or 4%. I think what needs to be said is it came as a big surprise because the sentiment in the market before that was not bullish. We were having some issues. Even the outlook for economic performance was also not that bullish. And then obviously add the COVID aspect, which was also coming as a headwind to the investing environment. There has been a lot of liquidity that came onto the market, and that liquidity was driving activities on the market, and most of that money was coming from local sources. So whenever there's money, the market tends to respond because of the obvious demand and supply dynamics on the stock market.
Thank you, Ranka, for that. I think surprise is the right word, because now we are seeing that ZSE is amongst the best performers in the sub-Saharan region. So maybe, Rufaro, you can add on to that.
Yeah, I think the other aspect of the market's performance that distinguishes it from the rest of sub-Saharan Africa is the fact that you've had foreign portfolio investors exiting the market for almost a year now, and their share of the floats of the listed companies is dwindling. Therefore, the supply side of scrip is smaller, and pricing is a function of supply and demand. And if the supply side is diminishing, then you have to pay more to get the shares. So a part of the movement that would be unique to Zimbabwe when compared to our the other countries in sub-Saharan Africa is this aspect of foreign portfolio investors exiting the market and basically reducing the supply of shares.
Okay, thank you, gentlemen. Still discussing on the local capital market. There's been a sentiment that the price earnings on the ZSE are above normal. So maybe we can comment on that phenomenon.
All right, so it's the issue of valuations. So with the way the market is actually moved, there's a lot of conversations around whether the ZSE is looking overvalued, or what between the ZSE and the local currency is looking overvalued. I think there's merit in that kind of discussion if you consider that this market generally, long term, it has been hovering around 3 to 3.5 billion US dollars by way of market cap. So now we suddenly find ourselves with a market cap in excess of 4.5 billion. And then the question that one asks is that supported by the fundamentals? Are the businesses that are listed on the ZSE seeing much growth in their revenue, much growth in their profitability to justify this kind of valuations? But but the demand is still there. Probably there's a change in the fundamentals, or there's a change in the perception that is happening, and that is actually prompting this kind of valuation. But we can't run away from the fact that a 4.5 billion market cap is difficult to justify, and we haven't seen much by way of the performance of the businesses themselves to justify that.
Yes, thank you. Now that you mentioned that the fundamentals in terms of valuation, we need to actually agree that for now there is inflation hedging in terms of the investors on the market. So is there a possibility that we are going to go back to the fundamentals of valuation?
Yeah, look, I like that you mentioned hedging, because what's going on in terms of, from a hedging perspective, is that there is consensus in the asset management community that it makes sense, or it's prudent to hold non-monetary assets because the inflation outlook is unclear. So certainly maybe the last 6 months we have seen inflation tapering off, and we've got some price stability, but it's not a given that this is going to be the case going forward. And the investment game, it's a forward-looking game.
Yes.
So what are the options? To buy non-monetary assets like listed securities, or to place the money on the money market? And I think the thinking in the institutional investment community today is that it makes much more sense to hold non-monetary assets like listed securities, and even if they don't believe that they are cheap, they believe that they're better off holding an equity than a monetary asset that can rapidly lose value if inflation ticks up again.
Thank you, Rufaro, for your views. Now we are going for a break. So afterwards, we're going to look at the outlook of the market, and thank you for that.
Munda magasi birira dine sitko kuti sitko ndo kuti mbeu.
Welcome back. I'm joined by Ranga and Rufaro, and we have been looking at the review of the local capital markets in the last 4 months. Now we are going to have perhaps a view on the outlook for the rest of 2021 and the expectations for the upcoming earnings season. So let me start with Ranga.
Thanks so much, Tawanga. So the rest of the of 2021, I think there's a lot of uncertainty in the market, given the overvaluation that we've spoken to. So the question among us investors is what's going to happen. But it's very clear that the market is looking overvalued right now. We've spoken about the valuation, the market capitalization at 4.5 billion, and the general belief that the market should be around 3 billion, 3.5 billion, unless there's a compelling case demonstrating that there's been some shift in the economic fundamentals, of which is not clear at the moment. So my view is that the market is likely to, is expected to correct. Whether it's going to correct in 2021 or not, it's a different issue. But if a market is looking overvalued, I think the natural expectation is a correction. So that is one thing that personally I'm expecting, some correction, maybe back to the around 3.5 billion, unless maybe from the economic fundamentals, we're going to start seeing something, a major shift that will then justify higher valuations. Then looking at the earnings, I think the earnings are going to have a bearing on the direction of the market, to be honest, because all along investors have been buying into an expectation. Now the upcoming earnings season is going to then give us an idea of whether those expectations were realistic or not. So if the numbers are going to come up better than expected, certain valuations are going to be maintained. But I don't see that, given that generally the economy is still looking very constrained in a number of ways, and I don't think disposable incomes have increased to a point where aggregate demand has shifted up and volumes are increasing. So in summary, I would say 2021 I expect some sort of a correction from 4.5 billion. I'm not so excited about the earnings scenario for most of the companies.
Speaking of economic fundamentals,
sorry, if I can just add to Ranga's comment. I think a big question that will also have a significant bearing on the rest of 2021 is what happens with COVID. Are we going to see a significant third wave, or have we seen the worst of COVID? So if you look at the global stage, for example, last year when COVID emerged, India was relatively unscathed. Yeah. They didn't have significant challenges, but they've got a massive second wave now. They've got huge new daily cases. They've got their hospitals are overwhelmed. It's a massive problem right now in India, which most people do not foresee. So it's conceivable that we could have a third wave that is quite serious, that would lead to another hard lockdown and have a significant negative bearing on the economy. Yeah. Or it may turn out that we've actually witnessed the worst of COVID and our economy will spend the rest of 2021 on a recovery trajectory. So I think that's a big question, and at this stage it's an unknown. How things will pan out from a COVID-19 perspective, and then the other unknown as well. I think Treasury has been very disciplined over the last 6 months in terms of the way they've managed the national finances. We have not seen significant growth in money supply or printing. That will also have a significant bearing on the rest of 2021. Are they going to maintain fiscal discipline, or will we see government, huge government programs funded by printing? That will also have a bearing on the rest of the year. So I think those two are significant unknowns that people will have to watch very closely.
Thank you, Rufaro, for that. Maybe we can perhaps focus on the lighter one pertaining to the government controlling money supply. We have noticed that the government has been mopping up our excess liquidity through open market operations. So maybe we can have just a brief comment on that. Ranga.
Yeah, so yes, the liquidity situation is another major topical issue. There has been, in fact, it's a deliberate policy of government to mop liquidity as a way of trying to manage inflation to the targeted levels, and also just to support the value of the local currency. And I think it has actually worked. In the last 6 months, we've seen that stability in prices, stability in the exchange rate, but also there's need to strike a balance between fostering stability on those major economic indicators like inflation and the exchange rate, and also making sure that there's enough liquidity to oil the economy. So I think we're actually at the borderline, if not slightly over the borderline, where I think the tightening is actually becoming it's becoming an albatross on the economy, in the sense that there is not enough liquidity to be oiling the economic machinery, as it were. So I think that is one area. But the impact of that on the markets have been sort of muted in a way, because there's still some sections of the economy that have got access to the liquidity, and that's why we have seen the market being pushed all the way. So there's a group of investors that have got access to that liquidity, in as much as the rest of the economy is going through a very tight liquid kind of scenario. So it's a positive development. It has been good, but then the question that comes is how sustainable is it? The stability and everything. I'm sure Rufaro can speak to that as well.
Yeah. Yes, before Rufaro comes in, wouldn't you say that it's maybe contrary to the basics of economics that maybe during a disaster or in times of need, you would expect a government to be carrying out expansionary policies and things like that to help the economy maybe recover or perform much better? Rufaro, you can come in.
So I think the question really is, what is what is the greater evil, to have runaway inflation, or to have tight liquidity in an economy that has issues because of a crisis like COVID? So I think that so fiscal discipline has been the choice that the government has made, because we have a history of hyperinflation doing tremendous damage to our economy. So they've chosen to err on the side of fiscal discipline. But I think the stability that we've seen over the next 6 months affords us an opportunity to liberalize things a little bit, because one of the challenges with notwithstanding the discipline that we've seen in terms of the government not printing over the last 6 months, is that from a foreign investment standpoint, they're still concerned that the valuation of the currency is wrong and it doesn't make sense. However attractive an opportunity in this country might be today for an investor to bring a significant amount of capital through formal channels, because they believe they'll be getting a haircut on entry. So I think there is a need to address this concern that that global capital markets have around Zimbabwe, so that you start to see foreign investment come in and play that role of being a stimulus, because we don't have the capacity to stimulate the economy without creating hyperinflation. But if we had significant foreign capital coming into the country, that would be the equivalent of stimulus, and that would actually be a sustainable way to turbocharge the economy. So I think that's, ideally that's the next step that Treasury is going to take, to say, look, we've had stability for 6 months. The next step is to endear confidence in global capital markets and start seeing foreign investment come in.
Thank you, Rufaro, for that. You are watching Analysts Insights. Stay tuned as we go for a break. Next, we'll be touching into international markets. Thank you. Welcome back. Now we are looking at international markets. So now to start with Rufaro, what are you seeing as the major developments on the global market, and perhaps how do you see any of them affecting us here in Zimbabwe?
So if you look at global financial markets, the S&P 500, the Dow, they've recently been trading at or near record highs. And they've mostly been driven by technology stocks, because in this COVID era, what we're seeing is a lot of people unable to go to the office. They have to work from home. So for meetings, they're using technology like Microsoft Teams, like Zoom. So the technology stocks that have benefited significantly, because people are moving towards working with these with the software, with this hardware. And so if you look at what's actually been driving the valuations of these markets higher, it's your tech stocks like your Facebook, Microsoft, Apple, Google, and that sort of thing. And I think that's a trend that we will see going forward. I think the world, what COVID has done is it's accelerated the adoption of technology. And even here in Harare, in Zimbabwe, we are seeing people working from home. We are seeing people adopt these technologies as well. And it's certainly going to have an impact on us going forward in terms of how we do business, what the value of office property is going to be, the kind of rental yields people can expect to realistically earn on office space, and there are all sorts of second and third order effects from the adoption of these technologies that will change the way we do business here in Zimbabwe.
Yeah, speaking of technology, we have noticed a major US index launching, we might say, a crypto index tracking the performance of Bitcoin and Ethereum. Can you comment on that?
Yeah, so I think that this is a trend that is not new in terms of people having skepticism about fiat currencies. There's always been some level of skepticism about governments' propensity to sometimes print money and debase currencies. So people have always been looking for an alternative, and I think traditionally before the rise of cryptocurrencies, what people would do is they would buy gold or they would buy property. And basically crypto is a technological version of alternatives to fiat currencies, and they've become quite popular. A lot of Silicon Valley luminaries have spoken highly of the future of cryptocurrencies, and they're starting to get broader adoption. You'll find some of the traditional banks globally have mentioned that they will build platforms that allow people to buy and hold cryptocurrency. So I don't think it's going away. I think that cryptos are going to be a major asset class going forward, but it's early days, and I think that there's from an investment standpoint, people need to think about the downside risks. There's a lot we don't understand about how they're going to function, about how they're going to be valued, and what the outlook is going to be. But what we can say with high conviction is that they're here to stay. They're going to be part of capital markets going forward.
Thank you, Rufaro. Now, Ranga, can you also comment on the fiat currencies versus digital currencies with regards to Zimbabwe?
Thanks so much, Talonga. Maybe before I do that, I may want to go back to the first question you posed about the major developments on the global markets and the impact on Zim. I think I like the idea that the global markets are feeling optimistic, behaving in a bullish way. What it tells you is that I think global risk aversion is actually improving. I remember when COVID started, all markets were affected. There was a lot of risk aversion across the globe, with all markets losing quite some bit. And we are seeing a scenario where markets are becoming very buoyant and bullish again. And the good thing about it is at some point, some of these investors will start looking at other markets and say, okay, we have done very well in these stable markets. Which other areas do we need to go into as we look for alpha? And we have tended to see them drifting to markets like ours, your emerging and frontier markets. And so that should be some cause for optimism when you're looking at the potential for capital coming into frontier and emerging markets. But obviously for Zimbabwe, we need to deal with exchange control issues that seem to be having becoming a disincentive to the investors, especially when you're looking at the developments on the stock market recently. I think the last 12 months, 18 months, we have seen foreigners being net sellers, and they're still selling out of their equity position, liquidating and going on to the auction system to try and take their money out. So obviously we need to do something to try and improve that sentiment that is taking money out as opposed to bringing money in. So once that has been addressed, and then you have a scenario where the global markets are feeling bullish and investors are looking for options elsewhere, you might actually start seeing some funds coming into emerging and frontier markets that are deemed to be stable. And then on to issue of digital currencies. I think the way I want to look at it is, okay, you try and understand what has actually caused the development of digital currencies. Alfaro has alluded to the whole issue with declining confidence in fiat currencies. And I mean, you don't have to look far further than here in Zimbabwe, where generally you don't get the view on the local currency has not been at its best. Generally, people are preferring to hold value or to savings in more stable currencies. So if in those developed countries, the players there are also starting to view, say, their currencies with some question marks, it tells us that maybe the solution to markets that always have currency issues could be digital currencies. So I think at some point in Zim, we had gotten to a point where we had adopted certain products or certain services or certain metrics as some sort of a pseudo currency. That's why we had the old mutual implied rate, people choosing to preserve their value in say equities, in currency, in hard currencies, and other things. So I think digital currency is something that us as Zimbabwe, maybe in future we could possibly look at and say, could there be a solution to our current problems?
Thank you, gentlemen. Now, to round it up, we have discussed about how the market has been looking generally. We have touched on money supply, and we have even tapped onto the international markets and how and what that means for us in Zimbabwe. So now, can we just get maybe two words as to what you think is going to happen, maybe with regards to everything that we have discussed, especially with the capital markets? I'll start with you, Rufai.
Look, I think that the market is looking overvalued, and there's quite, going forward, there's quite a bit of downside risk in terms of a re-rating. So from a local market perspective, I'd be very cautious about some of these valuations.
Okay, thank you.
I would say I think the economic outturn is going to have a big impact on the direction of the capital markets. Maybe the movements that we have seen are telling us something that we already don't know about major economic developments that are happening that could possibly at some point justify some of the valuation that we are seeing on the markets right now. I think everyone is looking forward to the harvesting season, the marketing season. So we know pretty much all major crops have actually, the marketing season have actually kicked in, a bit tobacco, maize, and maybe cotton. I think developments there, and also maybe outturn from other key foreign currency earners like in the mining sector, gold and platinum, and etc. I think we are. The market is actually waiting for statistics, is waiting for outturns, developments from the economic front that they may use to judge the extent to which the market is actually overvalued or undervalued. And I think if you had asked me, I would still think that the market is overvalued until we are presented with compelling evidence that the economy has grown quite significantly to justify these valuations.
Thank you for that, Ranga. Thank you to our guests, Rufaro and Ranga, and also would like to thank you, our viewers, for tuning in to this discussion. We hope that you found this discussion interesting. Please join us on our next edition. Please remember to like on Facebook and subscribe on YouTube on the handles displayed. You can feel free to send your questions and comments on those handles. Thank you. See you next time.